Ever heard of the stock market suddenly losing huge amounts of value and wondered why it happens? That's called a market crash, and today, we're breaking it down in simple terms. We'll explain what triggers these crashes, why investors panic, and how the market usually recovers over time. By the end of this video, you'll understand the risks, the patterns, and why a crash, while scary, isn't the end of the road. Today, we will talk about what is a market crash and why it happens. So before we start, make sure to hit the like button and subscribe to my channel. 1. Causes of market crashes. Several factors can trigger market crashes, often combining to create panic. Economic recessions, political instability, natural disasters, or financial crises can prompt rapid sell-offs. Investor behavior plays a significant role. Fear and panic can lead to mass selling, further driving prices down. Overvaluation is another common cause, where stock prices rise far above their intrinsic value, creating a bubble that eventually bursts. High levels of leverage, or borrowing to invest, amplify losses during a crash. Global events, such as wars or pandemics, can also create uncertainty, prompting sudden declines. Understanding these causes helps investors anticipate risks, manage portfolios, and avoid irrational reactions. Market crashes are complex phenomena, but recognizing contributing factors provides perspective and allows for better preparation. While unpredictable in timing, crashes follow patterns influenced by economic, social, and financial factors, making awareness crucial for long-term investors. 2. Historical market crashes. History offers lessons about market crashes. The Great Depression in 1929 saw massive declines in stock prices, unemployment, and economic collapse. The 1987 Black Monday crash occurred due to automated trading and investor panic, with markets dropping sharply in a single day. The 2008 global financial crisis stemmed from risky lending, over-leveraged financial institutions, and housing bubbles. These events illustrate that crashes can happen due to a mix of economic, financial, and behavioral factors. They also show that markets, despite dramatic declines, eventually recover over time. Studying historical crashes helps investors understand that downturns, while painful, are part of market cycles. Awareness of history provides context for market behavior, allowing investors to develop strategies to minimize losses, avoid panic, and remain focused on long-term goals rather than reacting emotionally to sudden drops. 3. Role of investor psychology. Investor psychology plays a central role in market crashes. Fear and panic often lead to irrational selling, magnifying declines. Herd behavior, where investors follow the actions of others without independent analysis, can accelerate crashes. Overconfidence during market highs can create bubbles, making markets vulnerable when reality fails to meet expectations. Understanding psychological factors is critical for beginners because emotional reactions can result in poor investment decisions. By recognizing fear, greed, and herd behavior, investors can take a more disciplined approach, avoiding impulsive actions. Emotional control is one of the most important tools in surviving market crashes. Awareness of psychology allows investors to respond strategically rather than emotionally, maintain long-term perspective, and reduce the likelihood of panic selling that locks in losses during downturns. 4. Overvaluation and speculation. Market crashes often follow periods of overvaluation and speculative investment. When stock prices rise far above the company's actual worth, driven by hype rather than fundamentals, a bubble forms. Speculators may invest heavily in hopes of quick profits, inflating prices further. Eventually, reality catches up. Profits fall short, economic conditions change, or sentiment shifts, triggering rapid sell-offs. Historical examples like the dot-com bubble in 2000 illustrate how speculation can create instability. Beginners must understand the dangers of investing based on hype or trends rather than fundamentals. Overvaluation increases vulnerability to sharp declines, and speculative markets are often unstable. Recognizing signs of bubbles, focusing on value, and investing prudently are essential to protect wealth and avoid losses during periods of irrational market exuberance. 5. Economic indicators and market health. Economic indicators, such as GDP growth, Unemployment rates, inflation, and corporate earnings affect market stability. Weak economic data can trigger investor concern, while strong growth can boost confidence. Rapid changes in these indicators sometimes lead to market overreactions, causing abrupt declines. Central bank policies, interest rate changes, and government interventions also influence investor sentiment. Beginners should monitor economic conditions as part of risk management, understanding that markets are affected by both real-world performance and expectations. Awareness of indicators helps anticipate potential instability, but timing crashes is nearly impossible. Economic health informs investment decisions, providing context for market trends and helping investors remain calm during volatility rather than reacting solely to market price swings. 6. How crashes affect investors. Market crashes can be devastating for investors, especially those heavily invested in stocks or using leverage. Short-term losses can create panic and force emotional decisions. Retirement accounts, education savings, and other investments may temporarily lose value. However, long-term investors who maintain a diversified portfolio and avoid panic selling often recover over time. Crashes can also present opportunities to buy undervalued assets at lower prices. Beginners must understand that short-term declines do not necessarily mean permanent loss, and that disciplined long-term strategies are crucial. Awareness of potential impacts helps investors prepare mentally, financially, and strategically for downturns, reducing stress and preventing hasty actions that could amplify losses. 7. Protective strategies during crashes. Investors can use several strategies to protect themselves during market crashes. Diversification spreads risk across multiple asset classes, reducing exposure to any single investment. Asset allocation balances high-risk and low-risk investments. Keeping an emergency fund prevents forced selling during downturns. Long-term investing minimizes emotional reactions to short-term volatility. Some investors use hedging strategies like options or defensive assets, though these require advanced knowledge. Regular portfolio review and rebalancing ensure alignment with goals and risk tolerance. Beginners should focus on low-cost, diversified investments and avoid panic-driven decisions. 8. Market crashes as opportunities. While market crashes can be stressful, they also create opportunities. Stocks or ETFs may become undervalued, allowing long-term investors to purchase quality assets at discounted prices. Historically, markets recover over time, rewarding patience and disciplined investing. Beginners can use downturns to build positions gradually, benefiting from lower prices and compounding over time. Understanding that crashes are cyclical rather than catastrophic allows investors to shift perspective from fear to strategic opportunity. 9. Staying calm and focused. The key to surviving market crashes is remaining calm and focused on long-term goals. Avoid panic selling, maintain diversification, and adhere to your investment plan. Education, patience, and discipline allow investors to weather downturns while taking advantage of opportunities. Crashes are part of market cycles, and history shows that recovery is likely over time. Beginners should view crashes as temporary setbacks rather than permanent losses. Staying informed, prepared, and emotionally disciplined ensures that investing remains a tool for wealth building rather than a source of stress. By focusing on the bigger picture, investors can turn market crashes into opportunities for growth and strengthen financial resilience over the long term. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.